here's a tax strategy where it actually makes sense to start your business as an S corporation and then later convert to a C corporation for QSBS, which is Qualified Small Business Stock Exemption. If you plan to sell your business down the road 5+ years from now, it may make sense to actually start your business as an S Corp first and then later convert to a C Corp for QSBS purposes. So let's go through the methodology of this and how this makes sense, and go through some examples, and let's get started. A lot of businesses that expect to sell their business in 5+ years will automatically start their business as a C corporation to take advantage of Section 1202, which is the Qualified Small Business Stock. The reason this is so beneficial is that you can exclude the greater of $10 million on that sale of your business, or 10 times your adjusted basis in that stock. So whichever is higher, you're able to exclude that amount on the business sale, which can potentially, that has a tax savings of $3+ million in the year of sale. So the qualified small business stock is such an important part to your business. However, there is a tax strategy that I've kind of just learned about where you can either start your business first as an LLC, partnership, or S Corp. In this situation is what I want to talk about today, that actually may make more sense to start your business first as an S Corp compared to a partnership or a C corporation. And then you can later convert to take advantage of the QSBS. So one of the reasons it may make sense to be an S Corp first is you will pay less in taxes, most likely, compared to a C Corp or a partnership, which you're subject to self-employment tax as a partnership, and you're subject to the double taxation, first the corporate tax rate, and then you're taxed second on dividends or payroll with a C corporation. So by starting your business as an S Corp first, you will pay less in taxes early on. And I will also say this really only makes sense. I'll go through the factors where I think this makes the most sense later on, but you want to make sure that your business is going to be profitable, especially bringing in at least $100,000 a year for this to actually make sense. So if you think your business is going to be at a loss in those early years, a C Corp may make more sense. And I really think it makes sense to talk to a tax professional and have them calculate what entity structure makes the most sense. But if you meet all the criteria that I'll discuss in a little bit, it may make sense to first start as an S Corp. So I'll talk through this tax strategy of first starting with an S Corp and then later converting to a C corporation for the QSBS exemption. So here's my chicken scratch of the necessary steps on how this tax strategy works. So the first is to start your business as an LLC or corporation, then elect your business to be taxed as an S Corp to eliminate that self-employment tax or reduce the self-employment tax. So the first step is to elect to be taxed in S Corp so you can pay less taxes. There's also a little bit less administrative and compliance requirements compared to a C Corp. The second is that you hope the value, or not hope, but you want the value of the business to go up over time. So you may start the business and buy your stock for $1. If you're going to take on outside investment, you want this value to grow, whether it be 1 year, 2 years, 3 years, 5 years down the road, where the value of this business will increase. There's a little rocket ship hoping the value goes to the moon. Step 3 is later converting to a C Corp so you can take advantage of the Section 1202 for the qualified small business stock. That is when the 5-year waiting period for the QSBS exemption begins. So you need to wait 5 years from the time you've converted to a C Corp to take advantage of the QSBS. Step 5 is actually sell the business. And then last is you're going to profit. When I say profit, you're going to get those tax savings on the qualified small business stock exemption. So let's look at an example of how this actually works and the practical nature of it. So the first is, let's say your business starts with an initial basis of $1. That's probably the most common that I see, is where a partner will buy their shares or their units for $1. Then over time, so step 2, the value increases. So let's say 2 years down the road, you take on an outside investor and you exchange maybe 10% of your business in exchange for, probably not going to do the math right, but let's say you take on $4.5 million. So your shares that you had were initially worth $1 are now worth $4 million because the 90% of the shares that you have are now valued at $4 million. So your shares went from initially valued at $1 to now valued at $4 million. So at this stage, we move to step 3, which we convert to a C Corp. You would basically exchange 4 million of the shares for the S Corp for the C Corp stock. So your basis in that C Corp stock is now the $4 million that you exchanged. Since I mentioned before that the exemption is either the greater of 10 million or 10 times your basis, in this example, your basis is $4 million, so 10 times that is $40 million. So moving on to step 5, let's say you sell the business for $36 million. Your initial basis was $4 million, so you just had a gain of $32 million. So since $40 million is what you are able to exclude, which is greater than your $32 million gain, you will not pay any taxes on the actual proceeds of the sale. However, you will pay long-term capital gains tax on the difference between the initial basis in the business, which is $1, and the $4 million adjusted basis at the time of conversion. So $3,999,999 will be taxed at long-term capital gains rates at the time you sell your business. So that is something to keep in mind. So when does this all make sense? So when is this strategy going to make sense for you? So the first one I already mentioned. This strategy is only going to work if your business is going to be profitable from the get-go and you think you will easily have profits in excess of $100,000 per year. The second is that your S corporation is going to be around long enough where you're going to get some of those tax savings compared to being a C Corp. So a C Corp or a partnership, as I mentioned before, will have you'll pay more in taxes than an S Corp on a year-by-year basis, most likely. So you will want to make sure that your S Corp is around long enough to kind of reap some of those tax benefits, because when you convert to a C Corp, it's much more complex to do it from an S Corp to a C Corp. So you'll need to get an attorney involved to do the conversion appropriately, whether that's through an F reorganization or a transfer of assets. And that's going to cost money. So make sure your tax benefits from the years that you are an S Corp compared to a C Corp or a partnership will outweigh those attorney costs. The third is you want to make sure the tax savings on the QSBS will outweigh the additional taxes that you've been paying because you're a C Corp for 5+ years. Because C Corps generally pay more in taxes than an S Corp. Yes, in the example I gave where maybe you sell the business for $10 million and you save $3 million in taxes with the QSBS, just make sure that your tax savings or the additional taxes that you're going to pay as a C Corp aren't going to exceed that $3 million of tax savings you get from the QSBS exemption. So, if you're a C Corp for 20 years before you sell the business, you may pay more than $3 million in the tax savings that you're going to get in the first place. So it's really important to make sure that you're going to save more on the qualified small business stock exemption than the additional taxes you're going to pay as a C Corp. You want to make sure that the value of the shares is greater than $1 million at the time you convert. As I mentioned before, you get 10x the amount of your adjusted basis, and that cap is $10 million. So if your value in the business isn't 1 million, 10 times that isn't going to exceed the cap of 10 million. So you really want to make sure that the value of your business is going to be more than $1 million, or your adjusted basis is more than 1 million, or you might as well just take the cap for 10 million, and this strategy isn't going to make sense. You also want to make sure you're going to sell the business for more than $10 million. Since you get a 10 million exemption with the qualified small business stock exemption, this strategy only makes sense to wait and increase your value so you can get 10x the adjusted basis. But if you're not going to sell the business for more than $10 million, this strategy will never make sense. And then you also want to make sure that you're planning to sell the business 5+ years down the road, which is the waiting period for the QSBS exemption. If you know that you're going to sell in 1 or 2 years, you are not going to be eligible for the QSBS exemption. So this whole strategy doesn't make sense. So if you meet the 6 criteria I just talked about, this strategy may make sense for you. If you have any other questions, please let me know. But I hope this helps outline this little known tax strategy on starting as an S Corp and then later converting as a C Corp to save on the QSBS exemption.